Did you know that the Federal Reserve has the power to influence nearly every aspect of our economy? From interest rates to unemployment rates, even the value of the dollar in your pocket? In fact, its decisions ripple through every business, household, and market. So how does it all work, and why does it matter for you? Let's break it down. Welcome to Factful Finance, where we take complex financial concepts and make them clear, engaging, and actionable. Today, we're diving into a crucial pillar of our economic system, the Federal Reserve, and its role in managing economic stability. This is Financial Economics, Part 10. And if you've ever wondered how a central bank can impact inflation, interest rates, or your savings account, you're in the right place. The Federal Reserve, often simply called the Fed, plays an essential role in keeping the economy running smoothly. But how? To truly understand, we need to explore its main tools and how they impact you and me on a personal level. First, let's talk about the Fed's mandate. The Federal Reserve is tasked with two primary objectives: promoting maximum employment and maintaining stable prices. These two goals might sound straightforward, but they require a delicate balance. If unemployment is too high, the economy suffers. If inflation is too high, your purchasing power takes a hit. The Fed is constantly weighing these factors, adjusting its policies to stabilize the economy. One of the key tools the Fed uses to manage economic stability is interest rates. When the economy is growing too fast and inflation is rising, the Fed might increase interest rates to cool things down. Higher rates make borrowing more expensive, so businesses are less likely to take on new debt, and consumers may hold back on big purchases. The goal? To prevent the economy from overheating. On the flip side, if the economy is slowing down and unemployment is rising, the Fed might lower interest rates to encourage borrowing and spending, stimulating growth. Let's talk about how this plays out in the real world. Take Liam, for example. Liam is a small business owner in Miami, and he's looking to expand. When interest rates are low, borrowing money to invest in his business is cheaper, so he goes for it. More loans, more hiring, more business activity. Now, let's say inflation starts creeping up and the Fed raises interest rates. Suddenly, borrowing becomes more expensive, and Liam has to rethink his expansion. This shift in interest rates impacts his decision-making and ultimately affects the wider economy. Now, the Fed's influence doesn't stop there. It also has the ability to buy and sell government securities, an action known as open market operations. When the Fed buys securities, it injects money into the economy, which can lower interest rates and boost spending. When it sells securities, it pulls money out of circulation, which can raise rates and slow down inflation. A more direct way the Fed impacts you is through its regulation of the banking system. Ever wonder why your savings account pays you interest? Or how the banks decide how much to lend? That's all part of the Fed's regulatory role. By controlling the money supply and setting reserve requirements for banks, the Fed ensures that the financial system remains stable and trustworthy. Let's look at a case study to understand this better. Olivia lives in Chicago and has a mortgage with a fixed interest rate. When the Fed raises rates, she doesn't see an immediate impact on her mortgage payment because her rate is locked in. However, if she were looking to refinance or buy a new home, she'd notice that the new rates are higher, which means borrowing costs have gone up. That affects her long-term financial plans, and it's something that the Fed directly influences. But what happens when the Fed makes a misstep? Just look at the Great Recession of 2008. In hindsight, many analysts argue that the Fed was too slow to react to the housing bubble and the excesses in the financial system. The result was a massive financial crisis that took years to recover from. This just goes to show that managing economic stability isn't always straightforward. One wrong move can have far-reaching consequences. The Fed also faces challenges from outside its control. Global economic events, such as trade wars, oil price shocks, or even pandemics, can have a ripple effect on the U.S. economy. The Fed must remain adaptable, using its toolkit to respond to both domestic and international economic shifts. So, why should you care about the Federal Reserve's actions? Because every decision made by the Fed impacts your financial future. From how much you pay for a car loan, to how your retirement savings grow, to the stability of your job, the Fed's policies are key to managing economic stability. As an investor, a consumer, or someone just trying to save for the future, understanding the Fed's role can help you make more informed financial decisions. What's your biggest money challenge right now? Is it rising costs, shrinking savings, or finding the right investment strategy? Drop your thoughts in the comments. I'll respond to as many as I can. Remember, while the Federal Reserve is powerful, its decisions are not the only factor at play in your financial life. Always consult a certified financial professional for personalized advice. This content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. If you found this helpful, you'll love what's coming next. Click the video on screen to continue your journey toward mastering financial economics.